Evidence suggests that car prices are falling after reaching record levels in 2022. So, if you're a prospective buyer of new or pre-owned vehicles, now is a better purchase opportunity than it was half a year ago. We're currently observing a unique, severe downturn in the car market, with experts foreseeing further price drops soon. Indeed, there are already indications of this predicted crash in 2023, with particular car models witnessing substantial price decreases. Thorough investigations by experts and analysts have unveiled some startling facts implying that this is merely the beginning, and more cars are predicted to depreciate in value amid this crisis. This is not a minor disturbance. It's a significant issue, potentially worse than the market collapse during the financial crisis. Let's explore this unprecedented car market crash in our lifetime, but first, we must comprehend what the days of supply concept entails. In the automotive industry, days of supply is a term used to gauge the balance of inventory against customer demand. It approximates the duration the existing stock will last if sales proceed at their current pace. To compute the days of supply, you divide the current inventory by the mean daily sales rate over a set period, usually 45 days. The resulting figure represents the number of days it would take to exhaust the inventory if sales remain steady. For instance, suppose a car dealer has a stock of 100 vehicles and sells on average 10 cars daily. In that case, the days of supply would be 10, meaning that based on the current sales pace, the dealer has sufficient inventory to satisfy demand for 10 days. The days of supply metric gives insightful knowledge into the equilibrium between supply and demand. Low days of supply indicate high vehicle demand and possible inventory shortage, requiring dealers to restock promptly to meet customer requirements. Conversely, a high days of supply suggests low demand and possible excess inventory, indicating that dealers have more vehicles than they can sell within a reasonable period. Therefore, dealers might have to alter their strategies, such as offering discounts or cutting production, to prevent inventory accumulation. Presently, many car manufacturers are dealing with a significant stockpile of unsold vehicles on their premises and a high days of supply. Ford, for instance, in the United States, is experiencing an unusually high supply of some of its truck models, with reports suggesting that certain trucks have an astounding 250 days of supply. The U.S. car market is experiencing a paradigm shift, transitioning from all-time high prices to a potential price war. Now, analysts are predicting a significant price downturn, primarily due to vehicle oversupply. A recent report by UBS forecasts that global car production will exceed sales by 6% this year, resulting in an excess of approximately 5 million cars. These unsold vehicles will likely necessitate price cuts to incentivize their sale, fostering a competitive pricing environment. While the price reductions may not materialize until the latter part of 2023, car manufacturers are already preparing for a potential price war. Indeed, some electric vehicle manufacturers have already begun reducing prices in response to market dynamics. UBS has warned its clients that ambitious production schedules present a significant risk of overproduction, leading to increased price pressure. The price war has already ignited within the electric vehicle sector, and UBS anticipates it to extend into the traditional combustion engine segment during the later part of 2023. According to analysts, family car manufacturers are likely to be most affected by price cuts, while luxury car makers are expected to fare relatively better. This discrepancy arises because family car models generally face stronger competition in the market and are more sensitive to pricing pressures. The situation may be even more challenging in the EV market. The combination of rising energy costs and high EV prices has rendered them less affordable for many customers. Consequently, EV manufacturers are expected to endure a significant impact, and it's already happening. Tesla, for example, has already reduced its car prices by up to £8,000 in the UK this January, aiming to make their vehicles more accessible to potential buyers. In fact, some of Tesla's more affordable models now fall within the same price range as mass-market brands like Kia. In response to Tesla's price cuts, other car manufacturers like Ford Motor Company and Lucid have also taken steps to reduce their own electric vehicle prices, as reported by Yahoo Finance. There is also evidence suggesting that this softening of car prices is permeating all segments. According to data released by Cox Automotive in April, Wholesale used vehicle prices in March decreased by 2.4% compared to the previous year, although they did experience a modest increase of 1.5% from the previous month. Additionally, a report from Kelley Blue Book on March 23rd indicated a 3-month consecutive drop in new vehicle prices, suggesting the emergence of a sustained trend. Historically, the car market has suffered from affordability problems, with both used and new car prices soaring to alarming levels. However, the current trend is showing signs of reversing, which can benefit those looking to buy a new vehicle. But for individuals who recently secured substantial loans to finance their vehicle purchase, this may not be good news. As car prices fall and interest rates rise, car owners in the U.S. are experiencing a decline in their loan-to-value ratios, or LTV. This implies that the amount they owe on their car loan exceeds the current value of their vehicle. The decrease in vehicle values follows a period of dramatic price hikes during the pandemic. The average interest rate for new car loans was 6.4% in May, up 4.6% a year ago, while the average price of a new car fell 2.5% to $36,472, according to a recent report by credit reporting firm TransUnion and market researcher J.D. Power. The loan-to-value ratios for used cars have increased from 104 in the first 3 months of 2021 to 125 in the same period this year. This means that the borrower's loan is now worth 125% of the vehicle's value. Satyan Merchant, a senior vice president of TransUnion and its auto business lead, expressed that as vehicle prices continue to increase and inflation remains high, consumers are resorting to higher LTV positions to make their vehicle purchases more affordable. However, these higher LTV positions can pose a risk for borrowers. If they encounter unexpected circumstances, such as job loss or financial difficulties, they may find it challenging to sell or trade in their vehicles without incurring significant losses. It could also lead to difficulties in repaying the loan in full, potentially resulting in delinquencies. The combination of rising inflation and tighter credit conditions is posing challenges for people looking to buy a car. As the cost of living increases and credit becomes less accessible, potential buyers are finding it difficult to afford new vehicles. This, in turn, has led to a higher number of unsold cars sitting on the lots of dealers and manufacturers. To address this situation and attract buyers, manufacturers and dealers are likely to be compelled to lower vehicle prices and offer substantial incentives. With a massive inventory of cars waiting to be sold, competition among manufacturers will intensify, leading to more price cuts. As the pressure to sell increases, it's very probable that manufacturers will need to maintain lower prices to stay competitive in the market. This downward pricing trend could eventually result in vehicles losing as much as 50% of their current value. This is obviously not good for automakers and dealers because they'd be losing a lot of money on every car sale. It'll be especially tough on electric vehicle makers, as most of them already lose considerable amounts of money. It'll be especially tough on electric vehicle EV makers, as most of them already lose considerable amounts of money on each vehicle they produce and sell. The main reason behind this is the relatively high cost of producing electric vehicles, particularly the cost associated with developing and manufacturing batteries. According to a report from Bloomberg New Energy Finance, the cost of building an EV is about 40% higher than the cost of building a comparable combustion engine vehicle. This significant cost disparity makes it challenging for EV makers to turn a profit without pricing their vehicles at a premium. However, with the predicted downturn in car prices, these manufacturers might be forced to reduce the prices of their vehicles even further to stay competitive. This would not only mean selling their vehicles at a loss, but would also jeopardize their ability to recoup their significant investments in research, development, and manufacturing infrastructure. This can potentially lead to a precarious financial situation for these companies and may result in consolidation in the EV industry, with only the strongest and most financially stable companies surviving. The ongoing price war is also likely to influence consumer behavior. On one hand, lower prices could stimulate demand for cars, particularly for electric vehicles, making them more accessible to a broader segment of the population. On the other hand, the ongoing uncertainty and potential for further price drops might cause some prospective buyers to delay their purchase decisions in hopes of getting a better deal in the future. This could result in a short-term decrease in demand, further exacerbating the oversupply problem. In conclusion, the predicted downturn in car prices represents a double-edged sword. While it presents potential opportunities for buyers to purchase vehicles at lower prices, it also poses significant challenges for car manufacturers, particularly those in the electric vehicle sector. Moreover, it may lead to a shift in consumer behavior and contribute to financial instability in the car market. This unfolding situation underscores the importance of closely monitoring the automotive market to navigate these potential challenges and opportunities effectively.